Per usual, everything else just for educational purposes only, is not intended as financial advice. It is Macro Monday. Let's take a look at some legacy charts and data, starting with IBIT. Not much going on with BTC. A lot of chop on crypto, a lot of chop on the market in general. I think everybody's just sort of waiting to see what Jay's going to say on Wednesday. A cut is pretty much priced in. It's just whether or not he's going to be hyper dovish or not, which maybe is unlikely. I don't know. He hasn't really been dovish historically, but maybe he's seen what he needs to see in the data to be dovish. For BTC, a little bit of a bear flag versus ascending triangle on lower time frames. You definitely have oversold conditions. You definitely have TKC clamp type stuff. It's probably a little early to pull the trigger and probably want to wait till Wednesday. Not financial advice, but if I'm doing anything big on MSTR, for example, like big on leverage, I want to see like one more card, you know what I mean? Just to get as much information as I can ahead of Wednesday, assuming Wednesday is going to be eventful at all. It could just be a nothing burger. But this also has all the early trappings of a TKC clamp. And this forms when you've got a very large move down followed by a move sideways. That allows the moving averages to catch up, specifically the Tenkin, and flatten out. So if you can get that, then you have yourself a trade, in my opinion. A little early here, a little early. Yes, it's oversold. It's oversold by a lot, but I would still be careful. ETH, same deal. I think ETH looks better to me on the 4 hour even. You know, on ETH, hey, is this a inverted head and shoulders? It could be, but doesn't look as atrocious as BTC does. ETH BTC looks ready for highs, looks ready to test how bullish ETH is on a relative basis. This is ETH over IBIT. Also something to watch. Looks just as good to me. I mean, this looks ready to do something. Maybe not this week, but potentially this week into next week. If this can break out again with a bullish TK cross, that's game on. You'll notice back here, the vanilla ETH BTC ratio got you in much sooner than ETH A over IBIT with legacy settings, but just something to confirm your suspicions. And then BMNR also forming that inverted head and shoulders here. And this looks right. So I'm fumbling with my words. Look at MSTR versus BNMR. It's no contest. I mean, this is at least trying, where MSTR is kind of free floating. So pick your poison, but those are the two I like for this week. If we can get a catalyst off of J Powell at the podium. For flows this week, past week, globally, we were positive, and we were positive the week before. It's just, is $1 billion enough? Almost feels like we need $1.5 billion in consecutive weeks to really make a dent. This is probably more of a representation of sentiment than anything. A lot of people are either up a little, up a lot, or break even at this point on ETFs. And maybe they're a little nervous at the lack of bullish price action. But we've certainly seen a lot come out of the BTC ETF. Schedule this week, pretty light, honestly, outside of FOMC on Wednesday. Maybe we'll get some fireworks on the monthly federal budget. Bunch of Fed speak at the end of the week. And then JOLTS delayed from October is coming out tomorrow. Rate cut probabilities here, expecting a 25 basis point cut higher even than last night. I've had a few people on Twitter saying they should go 50 instead of 25. I don't think that's going to happen, but 25 is pretty much set and done for on Wednesday. The issue now is inflation. Inflation is slowly creeping up, whether this is tariffs or rates, whatever it is. To see the trend move higher gives hawks something to work with here as ammo, because we certainly don't want inflation to run super hot, and we don't want inflation to be well above the 2% target for an extended period of time. But for the bond market specifically, if the Fed signals they do not care about inflation, or they do not care as much as they should about inflation, and you're holding a long bond and you're getting your yield eroded by inflation, you're going to want higher yields. So bonds are going to sell off. The bond complex is going to look weaker, and risk assets should do better to a point. The bigger issue is, as I wrote for Canary today, the 10-year yield is ready to just break up. Like, a lot of stuff is setting up here, but to see what we're seeing on the 10-year yield is scary to me, because if this does break up, it will have veto power over risk assets. There will be a point where people will start to get nervous again that should we see anything close to 4.5, now it's going to be tough to get to 4.5 in a day, let's be clear, but the higher the 10-year, the higher the 2-year, etc., not going to be great for risk assets. Something else to watch as I get to IWM. IWM and ETH have been correlated since 2018 to almost a 100% degree. So something else to watch on a divergence would be if IWM breaks up and ETH does not, or if the Qs are an analog for BTC and you're seeing IWM over Qs relative strength, you should see ETH BTC relative strength. That's just what we've seen. So if you don't think IWM is poised to outperform the Qs, you probably also don't like ETH BTC. But that's just what I'm seeing here, which makes sense to me. If ETH is following IWM and IWM is following the rate path and the rate path is going lower, then we're bullish ETH and alts effectively. That's where my head's at anyway. And if you look at the Fed's own inflation numbers month over month here, the most concerning thing about this inflation prediction package is core PCE. It continues to just slowly tick up. Now, these are all delayed because of the government shutdown, mostly under 3%, mostly okay, but this is not 2%. 3 is not 2, last time I checked. And this administration knows they have an affordability problem. Cutting rates to 0 is not going to help that if inflation comes back. GDP, however, looks fine. We can run it hot with AI spend and data centers and all that stuff. This isn't recessionary GDP. Obviously, it's at 3-4%, something in there. So that looks great. But real GDP is certainly lower than that. Now, it helps that gas prices are quiet and down and low, and year over year, they are down significantly. This is the first time in many years we've had an average price in the United States below $3. So that's a massive win for affordability, but it's not enough to entirely offset what we're seeing on the inflation front. Now, imagine if this starts creeping up. I don't know what would cause that, but we are all certainly lucky that gas isn't a problem right now. At least gasoline. Natural gas, another story. Fertilizer also curling down. This is something we talked about kind of weeks ago. You don't want to see the inputs to food costs and prices rising. Beef is at an all-time high right now. I think that's partly because of the fly issue. I forget the name of the fly, but supply-demand type stuff, similar to eggs and avian flu. So you don't want any costs rising to make that even worse. So to see this come down is good for food inflation, definitely. As far as liquidity is concerned, I think this is why a lot of people are concerned. Reverse repo basically zeroed out, just complete fumes in here. The market needs liquidity for something, it's going to have to go to the Fed, which quietly it kind of has been already to a smaller degree, but it is signaling there is slowly being a liquidity issue in the piping at the moment. If you look at BTC against global liquidity, it has diverged significantly. If you are a believer in this, your assumption is this will snap back. The jaws will shut towards some mean reversion, or BTC meets liquidity comes lower. Bears will tell you that, liquidity tops after BTC tops. So BTC is giving you a prediction here that liquidity has topped. Possible, but one of the biggest inputs to liquidity is DXY. So if DXY can hold the lows and stay low, liquidity should stay where it's at. If DXY breaks out here in 2026 above 100, then we have an issue. If this breaks to 107, that's not going to help anybody on the risk market side of things. One thing you'll also notice on correlations historically is Bitcoin has been correlated with emerging markets. Why? Because if dollar is low, dollar strength is low or falling, emerging markets do better. And it makes sense because there's more liquidity. There's more fuel for risk assets. So this looks like it's trying to maybe bottom, but it also has this multi-month head and shoulders here. It has the year-long potential rounded bottom. It's best that this just does nothing, just sit there, maybe bounce around a little bit, but doing nothing or lower is best for us. Gold looks okay here. Last night I looked at the gold miners. Those look better, I think, than gold. It just depends on your volatility profile. I don't see an immediate entry here either on gold, but you could imagine that if the Fed is super dovish and doesn't care as much about inflation as they should, then gold should move higher as well as people shift out of treasuries and bonds potentially and into hard assets like gold and BTC. I haven't listened to my usual talking heads today about where they think the market's going, but they've been bearish basically every day for the past 4 years. So I don't know why today would be any different, but we are sitting less than 1% below all-time highs on the SPY. Technicals still look like this thing is wanting to move higher eventually. Again, it just sort of needs permission, needs a catalyst. Maybe you have a bullish TK cross there in the works setting up. Maybe this ends up being a head and shoulders, not head and shoulders, cup and handle. Either way, this is not a bearish profile here. It is not. Now, it may struggle to break to where it is measured to, but in the moment, we're not bearish here. Even the Qs, same deal. Not a clean of a setup as the S&P, and actually the setup's more favorable, I think, in IWM, where you're already getting maybe an intraday all-time high today. Bullish TK cross, TBD. Still looks great. Looks great. There's nothing to complain about here. It had a multi-month run, broke down, reconsolidated, broke back up. That's what you want to see. And here's SMH. You know, if you want to see the culmination of bullish continuation, you're getting a quick TK crisscross here. So yes, this could fail and it could be all over, but it's going to need to come down quite a bit first to get that signal. Seeing the TK crisscross after this huge move is a great sign that there is potentially more in the tank here. And I don't have a lot of charts today because there's really not that much going on. Probably one of the more concerning charts is the Mag 7, kind of a head and shoulders vibe to it, but it could also set up for a bullish TK recross. A lot of the market right now is just chopping around. If we look at the Mag 7 under the hood, the worst four unquestionably in this order are Netflix, Microsoft, Meta, and Nvidia. Nvidia being just neutral effectively, but there is definitely not a trade here, and there hasn't been on any of these four in quite some time. And it's one of the reasons why you look at trend metrics at all to get you out of something like Netflix. Being below the cloud is not where you want to be if you expect prices to go up. What's really holding up the world right now is Google and Apple as they continue to just really move in a parabolic fashion. I mean, look at Google. It's moved from 140 to 320 in like 8 months. Wild. Amazon and Tesla is certainly more neutral, but I still like long-term Tesla ideas if this thing can hold and break up at any point. You know, you just DCA into some Tesla over the next 3 months, assuming it's a cup and handle, as long as that can hold. And Amazon has certainly been disappointing, unable to hold that 235 level, but it doesn't look, it's not, you know, something like this isn't going to drag down the index, whereas Nvidia would, Google would. So collectively, everybody's sort of just waiting to see what Jay's going to say on Wednesday, but I would definitely keep an eye on the 10-year, definitely keep an eye on the bond complex, because if there is a extremely negative reaction, it's because Jay is signaling in the meeting that there's some significant QE type activity or behavior going on, not QE, whatever. If the bond vigilantes come out with their fangs and sell off the bond market, equities are not going to be happy. So best case is maybe bond people aren't excited about it, but this doesn't like break the market and equities can go on their merry way. That's all I have for this one. Give me a like, dislike, comment, share, subscribe, and happy trading.